Hey, what's up guys? It's EZQ Chiu here. So today I'm going to talk about this little known chart pattern that is best used to spot the starting point of reversals or retracements. You ready? It's called the piercing line pattern. So by the end of this video, you will have embedded this powerful pattern in your memory, so that the next time you see this pattern in the charts itself, this embedded memory will allow you to know exactly what to do and how to profit from it. Ready? Let's go. Okay, so first off, what is a piercing line pattern? So this is what it looks like, just like an ordinary two bars that you see in the charts itself, right? But this is no ordinary two bars, all right? This combination is the piercing line candlestick pattern. It helps traders to spot when the market might switch from going down, which is the bearish, right, to heading up, to bullish. So think of it as a signal that says, hey, the market could be about to turn around and this might be the good time to buy. Okay, so here's how it works. Number one, there are two candles. This pattern consists of two candles on the price chart itself. The first candle is usually red, which is bearish, right? So meaning that the price has decreased, there's selling momentum. The second candle is green, which is bullish. And here's the thing, it opens, the opening of the candle, lower than the first candle low, which is the red candle low. The green candle opens lower than the red candle low, okay? But closes higher than the middle point of the first red candle. Now, this pattern can indicate that the market is starting to rise. Alright, so but for confirmation, to be sure that this is a strong signal to buy, what we want to do is to look for the third green candle. So this third candle should rise higher and completely cover the previous red candle. So if this happens, which I'm going to show you, right, it suggests that there's a good chance that the market will keep going upwards. So what does this pattern means? Alright, so this pattern tells a simple story. So like at first, right, the sellers were in charge, pushing the price downwards. But then the buyers start to take over with the first green bar that closes above the middle point, driving the prices back up. So if the second candle closes above the middle point of the first one, that's where the market may be about to reverse, shifting from a downtrend to an uptrend. So this means that the price that was falling might start rising. I say might, okay? So this pattern is helpful for beginner traders. For example, not just beginner, but at the start. We're going to add all the combination, right? But at the start, when you see this, right, it gives you an idea. Okay, this is a potential reversal, potential area for us to buy. If the market drops for a while, here's the key, it's not sideways. The market is dropping for a while, you spot this pattern, it could indicate that the price may rise. Now, let's go through on how to spot a piercing line pattern when it forms. So in order to recognize this pattern, you see two things, right? You need to see two things. The first candle is a big red bearish candle, showing that the price has dropped. The second candle is a green bullish candle, opening below the red candle, but closing above the halfway mark, the middle point of the first candle, the first red candle. This pattern becomes even stronger if the second candle shows higher volume, meaning more people are buying than before. And then to add on, if it appears at a support level, there's something that's holding it, there's a piercing pattern, and this piercing pattern is at a support level, right? Support level can be a lot of stuff, right? Can be the support and resistance level, can be a trend line, can be a moving average, Bollinger Band, etc. This increases the probability of this working out itself. So now, here are the things to keep in mind. When analyzing this pattern, it is good, important to also check the trading volume. The number of trades that is happening at that moment, whether you're trading stocks, Forex, crypto, etc. The number of trades that's happening at the moment, volume. So think about it this way, if more people buy during the second candle that is formed, it adds strength to the signal, meaning that it's not just an ordinary green bar itself, right? A higher trading volume means that a reversal is likely to happen because many traders are now banging on and betting on the rising prices itself. So you can also check trading volume with volume indicators out there, all right? So first one, trading volume, right? Look at the volume, number of trades itself. If the second candle has more volume than the first one, there's strong buying interest, confirming or increasing the probability of the reversal or a retracement upwards, okay? Support levels. The pattern works best near a support level. Like I mentioned, it could be a support and resistance level. It could be a moving average, a strong moving average, obviously. It could be trend lines, channels. It could be Bollinger Bands, etc. That's where the price has bounced back before, okay? And then it's probably going to bounce again over here. The third one, market conditions. All right, you should always consider, say, other factors. It could be news. There could be the broader market trends. So what this means is that, for example, what is the trend in the higher time frame? All right, say you spotted a piercing pattern in the lower time frame. Say, example, the 1 hour. But what is the trend in the higher time frame? So, and is this the reversal or a retracement to go back in line with the higher time frame direction? So let's say the higher time frame overall is in an uptrend. The higher time frame overall is an uptrend, the daily, the weekly, for example. And then in the 1 hour, for example, the market is going down. And then it formed the piercing line pattern. So this piercing line pattern shows a reversal, right? So now you're not trading against the bigger trend. If you enter on this piercing line pattern, obviously with support, volume, etc., this will allow you, and this increases the probability because now you're trading in line with the broader context, the higher time frame direction, whereby it increases the probability of this trade working out to eventually be potentially the starting point of this move back up. So maybe in the higher time frame is just a retracement before heading back up. In the low time frame, this could be a reversal before heading back up. So, but this is the key, combining the market conditions together. All right. The key features of a piercing line pattern in trading. The pattern involves two main candles. The first is the bearish, the second is the bullish. The second point, the midpoint rule, the middle point rule. The second candle must close above, not just the bar spike. It must close above the halfway point of the first candle in order for it to be valid. Closing is always the key in chart reading. All right, closing shows where the market volume is. All right, where the strength of that specific time frame is. Okay, now third point, confirmation. So ideally, you should wait for the third bullish candle to appear to confirm the pattern before you act. Okay, fourth, volume. Higher trading volume during the formation of the second candle, it adds the strength to this signal itself. And the last point, support levels. Like what I talk about, all these support levels, right? This pattern forms best and works best when it's at a strong support level where price has bounced. Okay, so now let's take a look at this. The piercing pattern in this case, right? Same thing, like what we talk about, uses two candlesticks. The second one is the bullish and opens below the close of the first bearish candle. So next, the buyers drives the price up so that the second candle closes more than halfway up the first bearish candle. So this suggests what? A possible reversal to the uptrend, correct? Now, remember to look for the third bullish candle that opens above the second candle and closes higher than the first bearish candle. That is the key. Okay? So, when the two green candle covers the previous red candle entirely. So that's where, right? So first, you see the downtrend. with the red candle, making lower lows. Eventually, price reach a support level, like I told you all the different support levels, where buyers starts to come in, where the buying starts. Then the green candle forms. Then after the green candle forms, that's where the confirmation candle comes again, and then another green candle appears, and then completely covers it. So this suggests what? These two bars suggest what? That the buying pressure is increasing. The uptrend might continue with the market making higher highs. Okay, so these two bars now engulfs the previous bar itself with the combination of two bars. Not one bar, but two bars. Okay, so now you know the theory, right? So here's how to enter the trade with the piercing line pattern. Okay, so let's look at the example here. First off, we see a bearish downtrend. Now with price making lower lows and lower highs. So eventually, it keeps going down, it hits a support level where price and the buying starts to pick up. So now, at this point, the piercing line pattern forms, correct? So you already know this in your memory area. I kept repeating it, correct? So showing that the buyers are getting stronger. So then we see the green bullish candle that closes above the 50% of the previous red candle, correct? Yeah. Then this green candle completely covers the red candle, the next one, confirming the pattern and suggesting a potential uptrend. So then as a result, the price rises higher with higher highs, making higher highs, and then higher lows, indicating and confirming a bullish uptrend. All right, so now how do we enter the trade itself? First off, for entry, there are two ways. Okay, number one, entry can be at a pending order above the high of the red bar. Wait for price to go up, trigger a pending order. All right, now if you want to be a little bit safer, the second option, you can enter at the close of the third green bar. Okay, so now for your stop loss, you can either, number one, place it below the low of the third green bar. That's where if you're a little bit more aggressive, you want to aim for a bigger risk to reward ratio, and you confirm that, hey, there's a lot of supporting factors behind it, that's where you can use this. Or if you want to play safe, that's where the second way to place your stop loss is to place it below the low of the first green bar itself. So now, for take profit, I would take it at the previous swing high. Now, in order for you to do this, if you take this pattern along with the broader context, the higher time frame, remember I talked about the higher time frame that is in the same higher time frame trend direction, this can be the starting point of the piercing line, the reversal point or retracement for a big move back upwards, resulting in a big risk to reward ratio. But of course, right, things may not always go your way, right? So therefore, your stop loss placement will be at the right spot, which is the two placement that I told you, to cut off the trade should the market decide that, hey, this is not the reversal point, and then it will go up, and then maybe after it go back downwards and continue downwards. So that's where we want to cut it off. But when done right, obviously with the right risk to reward ratio, this becomes a worthy trade because this trade can really move up in line with the bigger trend direction itself. Like they say, the trend is your friend, and now the piercing line pattern is now your friend to trade in line with our bigger trend direction. All right, so now let's do a quick recap. All right, the piercing line pattern, it's seldom used price action pattern and that nobody really talks about. That you can use to identify potential reversal or retracement at the starting point itself. The best part of the piercing line pattern is that it confirms with the third bar that fully engulfs the first red bar. So that's where both bar 2 and bar 3 are combined. Right? So do note that you should always use the piercing line pattern in confluence with other factors such as the support and rejection levels and more, like what I told you about, plus the combination of higher time frame direction. All right, so there you go. Right, so now add this chart pattern to your library of arsenal. So not just for chart reading, but also the key starting point of reversal and retracement execution. So thank you so much for watching. If you enjoyed this video, please give it a thumbs up, right? It really helps to keep the channel growing. And if you are new here, don't forget to hit that subscribe button and turn on the notification bell so that you never miss an upload. So we also love to hear from you. right? Drop a comment below and let us know what you think or what you like to see next. I mean, your support truly means the world to us. It keeps us motivated to bring you awesome content every week. And if you're keen to learn more, I've created a free 5-part comprehensive training where I show you exactly how I trade using my lifestyle method. Link in the description below.